All right, let's bring in Mike Wilson. He is Chief Investment Officer and Chief U.S. Equity Strategist for Morgan Stanley. And Mike, just on these points, you're not worried about inflation, at least in regards to what it means for the markets.
Well, that's right. And I mean, we're just going through all these numbers. It's like, alphabet soup, all these different measures of inflation. And so what we do as equity strategists and investors is we look at earnings. Earnings, tell the story you need to pay attention to. And there, it's a straight line up, right? We've talked about this numerous times on the show. Earnings revision breadth is a V-shaped recovery, okay? So in other words, companies are dealing with what's going on right now. Does that mean it's going to continue to be at this pace? We don't know, but that's a good leading indicator for what earnings are going to be doing over the next 6 to 12 months.
And the reason you think it is not affecting margins to this point, and it won't affect margins from here, I guess, is the bigger question. Well,
I think the bigger point is that in the first quarter, earnings revision breadth was terrible. We were talking about that. That was a function of a bunch of different things. And then tariffs, the threat of tariffs and around Liberation Week is when the revisions literally plummeted. So what's going on now is you're just getting a reflexive move off of those lows. And I think people are looking backwards on this issue, and the markets are already past it. Does that mean that tariffs are not going to affect trade? They're not going to affect, GDP growth and things like that? Of course it is. But the market has already discounted all that in the first quarter for the most part. Now we've discounted a lot of recovery. So that's probably the bigger risk now is that the stock market is, once again, trading ahead of the average person, and they figured this out. So could we have a pause in here of some kind in the third quarter? Sure. But I'm getting more confident that our earnings numbers are probably too low now for 2026.
And that's the reason you think that this is not your average run. You've actually, I think, 7,400 you think that the S&P could get to? It's a gain of more than 12% from here over the next 12 months?
That's right. 7,200 has been our bull case. And what we said recently, and what we said recently is that we're leaning more towards that case because that's an earnings story. Yeah. And that was our call 6 months ago as we laid this out. We said, look, the first half's going to be tough. They're going to kitchen sink it. They're going to do all the negative growth stuff, and then they're going to flip the switch. They just did that faster and more violently than we expected. So now that second half story is playing out even quicker. But it gives us more confidence that the earnings story looks pretty good on 2026. I mean,
you look at the Mag 7 effect on the S&P, doesn't it have the same effect on overall on earnings? It must have an outsized effect.
Absolutely.
And is AI started with what we saw from Meta and Microsoft and others? Is it happening faster than we thought? And you could boost 2026 earnings estimates based on AI catching fire even more than it is, couldn't you?
This is probably 50% of our view for next year, which is that, the big mega cap companies are actually the most facile. They know how to use this data better than anybody, right? So let's just take a look at last night. We have these companies growing 20% top line, and they're cutting employees. All right, so that's a sort of a premonition to what could happen next year.
And it's like numbers that you look at. That's what I said. Mark Zuckerberg, he was at Harvard, like screwing around, and their revenue in a quarter is like, I forget what it was. It was like 40 billion. Yeah, it's mind-boggling, and they made $18 billion of profit.
Yeah. Now they're not generating. They are generating. I think that's probably a good example where they are generating a higher ROI, but we're not seeing a huge revenue impact yet. This is still a cost-cutting efficiency technology. But the big exciting part for next year is, can we see that technology now diffused into the broader economy?
Well, this is what I was going to ask you. You said the big guys can handle this. What about smaller companies? Because small businesses make up the majority of employee growth in this country.
And that's why we've been less bullish on the smaller names, because they don't have the scale. They also don't have the ability to mitigate some of these tariff issues because they don't have the supply chains sort of locked down. But I'm getting more optimistic that maybe we could see solutions pushed out to a wider group of companies. That's probably a fourth quarter call, first quarter call. And the other variable, of course, is the Fed, who remains on hold. Right. And that also, higher rates is a headwind for the smaller businesses.
And I guess that gets you to this question of whether you have a have and have-nots economy, and whether that dual economy is going to eventually impact the broader stock market or not.
Well, that's our hope. That's what we're getting more excited about for 2026. We actually can see that now. We've been out of consensus, sort of bearish on small caps for 4 years now running. And it's been right, but those calls eventually flip on you. So I think that the two things we're looking for is the Fed to get actively more dovish on rates specifically, and then we'll maybe see some of this technology start to get diffused. Now, don't forget that most of the economy, the private economy, has been in a recession or a soft recession now for the better part of 3 years, and this is part of the tax plan change, right? Is you're trying to move, the mix of the economic growth is shifting from government, okay, to private companies. And that allocation process should pay dividends in 2026 and 2027 on the earnings front.